Cast is now starting. All attendees are in listen-only mode.
Hi, everyone. We're going to get started in just a minute. Okay, let's get started then. Welcome, everyone, to the Restaurants Executive Review. My name is Alan Lee. A quick outline of the program today. First, we're going to cover some industry trends. Then we'll go over some performance metrics. And we're going to spotlight a few companies today, specifically Potbelly's, Wendy's, and Denny's. Finally, we'll have some warning signs and debt metrics that we'll go over. If you have any questions during the program, you can go ahead and submit them, and I'll try to address them as we go. Otherwise, we will have time at the end for more questions, so don't worry about that. So without further ado, let's get started then. So, restaurant industry. Overall, restaurant sales have continued to grow this past year. The impact of the pandemic is lessening. Restaurants have been open with pretty much no restrictions since last year. Now, we did have that Omicron wave in late 2021, early 2022, that temporarily shut down dining rooms in some markets, but that was relatively short. You can see on the chart on the left here that little dip in sales around that time, but since then it's been a fairly upward trend. For monthly sales, in August we're up about 11% year over year, and that's following a 10% increase in July. Now, the main driver behind this has been menu price increases. Normally, restaurants probably raise menu prices maybe once a year, but with the heavy inflation that we've been seeing, a lot of companies are doing multiple price increases just to keep up, really. Now, the flip side of this has been weakening traffic trends. Last year, the country was just opening up. There was a lot of pent-up demand to go out to eat. That demand has mostly been sated by now. Customers are facing inflation, so they're cutting their discretionary spending. And for those that are still spending, there's a lot more competition for those dollars than just food. Now, another factor here in the sales growth has been the return of store expansion. Now, we saw thousands of restaurants close in 2020 and 2021. A lot of these were weaker, underperforming locations, and some stores that ended up being, relocated. A lot of companies delayed their store expansion to kind of preserve liquidity. But now that the pandemic is kind of receding in people's minds, these companies are getting back to it. One caveat to this is that we're still seeing some supply chains have difficulties. So that's, limits on raw materials, building supplies, and construction in general. That's pushing some, openings into next year. It's not really the restaurant's fault, just how it is. And then one last factor I wanted to address is the off-premise sales. Now, off-premise as a whole has proven fairly resilient, even with the full reopening. Restaurants have really leaned into it, trying to integrate it better with their normal operations. For QSR and fast casual, that means, expanding their drive-thrus, the mobile integration. For traditional, that means expanding their, delivery options, partnering with more delivery partners, redoing the layouts, that kind of thing. And the result is that many of these full service restaurants are still seeing anywhere from 20 to 30% or more of their sales coming from these off-premise channels. A few examples here. Cheesecake Factory at 25%. This is all 2Q figures. Applebee's at 26%, Chili's at 34%. That's still near double pre-pandemic levels. Part of this you can attribute to maybe virtual brands for some of these, but it's really an indicator of how we've changed as consumers. We're accustomed to the convenience of this off-premise service. And I would expect probably some of these to tick down a few notches maybe, but they're going to stay well above pre-pandemic levels. Now, the growing sales, the pandemic getting further in the rearview mirror, that's all a good thing, but it's not all good for restaurants. The main issue we're seeing in the industry is the high inflation. Now, commodity inflation has been in the double digits for a while now. It's particularly high for beef and poultry. There's some hope that as we start to lap some of the high inflation in the prior year period, as some of these supply chain issues get resolved, gas prices are coming down, that this inflation will start to moderate in the second half. Early indications from 3Q are that this has been the case to a degree, but even then, most companies are still expecting low teens levels of commodity inflation, at least for the balance of this year. And the other side of the coin is labor inflation. Labor costs are up, not just minimum wage hikes, wage rates in general, but a lot of it's from benefits and also increased use of overtime and training. There's still a lot of turnover in the restaurant industry, and when you're short-staffed, you end up having to rely on overtime more than you might like, and then spending more on training new people. The actual hiring process isn't necessarily that difficult. Companies are getting applicants, but retaining those workers is still difficult. On a macro level, food services employment has been increasing for 20 straight months. On the chart on the right, you can see the hiring has slowed, however. The National Restaurant Association, they estimate that the industry is still short about 600,000 jobs from pre-pandemic, about 5%, and about 2/3 of operators, not just casual dining, but QSR and all the rest, they're still reporting that they're understaffed. So it is still a broad-based issue affecting the industry. Now, the response to this from most of those restaurants has been to pass on these costs to the customer, the price increases that we've been talking about. But they do have to be wary of pricing customers out. Overall retail inflation is still very high, 8.3% in August, and that's only a small step down from 8.5% in July and then 9.1% in June. And then, as I mentioned, traffic's already down. It's going to go down more every time restaurants raise prices. So what we are seeing in some cases is restaurants deliberately keeping their price increases under inflation in order to try to preserve this kind of value proposition. Darden is one of those companies. They're expecting something around a 5% price increase in the coming months, and that's under what they expect to be 6% inflation. Now, the one positive in this situation is that the main competition for restaurants, grocery stores, are seeing even higher inflation rates. The chart at the top right is showing the year-over-year price change, and the gap has really grown over the course of the year. In August, there was an 8% increase in food away from home prices, that's restaurants, bars, stuff like that. And you compare that to a 13.5% increase for food at home, which is your grocery stores. All right, so that takes us to our metrics. I'm gonna zoom out a little bit. Okay, so sales. As a reminder, our coverage falls into four main categories. We have casual dining here in blue. These are your full service traditional restaurants. Then we have fast casual in red and the QSR in yellow. And then I'll scroll down. And then the green is the experiential ones like arcades, bowling, that kind of thing. Now, as I went over before, the overall trend has been sales growth, though slowed down, partly as the comparisons have become tougher. Now, last year, the casual dining category was a bit mixed when it came to sales. some up, some down. But right now we're seeing increases across the board. Some of the larger increases actually are from companies that had been underperforming before. Those that needed the dining rooms to reopen to get back on track, which they've executed on. Darden had about a 34% bump. That's partly because their fine dining banners have bounced back very well. That's not to say the QSR and fast casual aren't also growing quickly. Chipotle had about a 19% increase. A lot of that's due to their store expansion. And then Shake Shack had a 32% increase. Similar story there. One exception I did want to note was Fiesta Restaurant Group. That decreased there from 584 to 372. That's mainly because there's a sale of the Taco Cabana banner, about half their sales. And then Steak and Shake, again, they're in the process of refranchising a lot of stores. That process is going to reduce your top line. So with store count here, as I mentioned, the landscape isn't as uncertain now as it was before, so a lot of restaurants are looking to expand again. The pace of this expansion varies, though. We have a bunch that are still being very conservative. They're only planning a handful of store expansions this year. BJ's and Chuy's, they're still testing the water. Others are full steam ahead, like Chipotle, Starbucks. They didn't really stop that for that long. Chipotle, they opened over 230 stores last year. I think their plan is 250 this year, and they're on track for it. And then again, similar to last year, we have some companies that are still looking to kind of trim their store base of the underperforming stores. Red Robin's one of those. Denny's is another, which we'll go over later. But Dine Brands is a good example of one in both directions, actually. There's been net growth in their IHOPs, but also a slight decline in Applebee's over the same time period. And then again, some of these big increases you see in the QSRs like Yum Brands and also Starbucks, some of that's coming from international areas like Starbucks in China in particular. A few other ones to point out, Restaurant Brands, that 1,200 increase, that was because they acquired Firehouse Subs late last year. And then Jack in the Box, similarly, they had about a 600 count increase. That was because they acquired Del Taco earlier this year. Part of the reason Jack in the Box acquired Del Taco was to drive future store expansion. Their plan is to try to get the franchisees of each brand to kind of open up in the other brand, kind of cross-sell in that case. Those negotiations are still in the early stages, and then Jack in the Box is also negotiating with its own franchisees to kind of get them to open more Jack in the Box stores because their store count had been kind of flat for several years. So moving on to comps, this is the year-to-date comps, so just for the first half. And remember, this also includes a bit of the impact from the Omicron wave we had early, like in January, February. Again, this growth has been mostly price-driven, and that's consistent across all the categories here. Traffic is flat or down, but menu price increases are really pulling the weight. For a lot of the companies here, it's a pullback from the big bounce they had last year when we were just reopening. But for the casual dining, that still represents double-digit or even just solid comp growth on top of growth in the previous year. And when you compare to pre-COVID sales levels, all or nearly all are positive compared to that level. A few ones that I wanted to point out here, Wingstop had the 1.1% decline, kind of sticks out like a sore thumb. That's partly because they had, they're lapping very high growth in previous years. They had about 30% comp growth in 2020 during the pandemic. There's a lot more competition in the chicken wing space nowadays. But in terms of timing, they're just like a little ahead of the other QSRs. You see Jack in the Box is in a similar situation. They were one of the first QSRs to get back to positive comps in 2020. And for the year-to-date period this year, they're flat. In fact, you can see a lot of the QSRs have returned to that low single-digit comp growth. That's kind of what they were posting before the pandemic. Yum Brands, they expected 2 to 3% comps across all its banners this year. So here's our first spotlight of today, which is Potbelly. Potbelly is a recent addition to our coverage. We have them rated as an E1. But there are a bunch of positive signs for them. It's possible we upgrade them in the near future. So they are a fast casual chain with about 440 stores, mostly company operated. They made a bit of news early on in the early months of the pandemic when they said they might have to close up to like 100 stores permanently due to the shutdowns. It ended up being only about like 30 closures, so not as apocalyptic. And despite them being fast casual, they had a lot of issues because a good chunk of their stores are in more urban areas, and they relied on the office worker kind of lunch crowd for a lot of their sales. The return of these office workers this year is a big part of why their comps have recovered. Overall comps are up 17% in 2Q, but the comps at these business district stores were up about 61%. Now, as things continue to normalize, the company wants to kind of get back to store expansion, but instead of doing it themselves, they want to do it through franchisees. They have this franchise growth acceleration initiative under which they want to refranchise about 99 stores over the next 3 years. And now these franchisees would sign long-term development agreements. It's a bit ambitious, these goals. They're targeting 10% unit growth by 2024, and then probably 85% franchise rate by over a 10-year period. But we're still in the early stages. Actually, just this week they announced that they announced two agreements. One with an existing franchisee in the Tampa area. They're going to open about 14 stores down there. And then another new franchisee is going to open another 5 stores in the central Illinois area. So yeah, early stages of that initiative. Of course, as we've seen with other companies, the refranchising tends to be good for your margins. It improves your cash flow a lot, but it does come with its own risks. You have less control over the quality. The smaller franchisees may be more susceptible to business downturns. You really don't want to be in a position where you have to bail them out. But it's not necessarily a bad decision. It's just a different way to go about it. We believe Potbelly's emphasis on this franchising is partly due to their pretty limited liquidity. As of 2Q, they only had about $15 million in cash and then $12 million available under their revolver. Now, the good news is that in July, they got full forgiveness for their $10 million PPP loan. So the balance sheet is in a much better place after that. That was about like half of their outstanding debt. They also have an equity offering program for up to $40 million they can issue in shares. They haven't done any of that yet, but if they need to, they can. So overall, Potbelly is on a better path, I would say. Their balance sheet is much, much healthier without that $10 million loan. The runway is a little bit much less bumpy now, but it remains to be seen. Their margins have been pretty thin, but menu price increases recently have kind of bumped that up a little bit. Now, connected to that, we're going to talk about gross margin a little bit. Gross margins have taken a hit across the industry. It's basically a function of the commodity inflation. Companies have been increasing prices, but they can't do it on a dime. They can't do it too quickly, and they don't want to raise them too high. Again, the perception of value, being a value option, is important. Customers were accepting of higher prices last year, but they don't have infinite patience when it comes to that. At the same time, we're seeing a return of more promotional activity, especially compared to last year where there was little. It's not to the level of where it was pre-pandemic, but it's definitely eating into margins to a degree. One positive we've seen this past year is that the shift back to more indoor dining means the stores can pay less in terms of supplies and packaging costs. Delivery is convenient, but it also adds costs to the bottom line. Now, of note here, Dine Brands and Yum, they show increases in gross margin. That's mainly because they're nearly 100% franchisers. Compare that to like a McDonald's. McDonald's is a very high franchise rate, but they also operate hundreds of stores themselves. And McDonald's in particular, they did take a hit when they closed about several hundred stores in Russia. All those stores in Russia that McDonald's had were company operated. Now, SG&A margin has shown improvement compared to last year. That's mainly due to the growing sales. That's leveraging occupancy costs. That's leveraging administrative costs. The one thing going in the opposite direction there is labor costs, which are still rising, as we discussed before. A few ones to point out here: Jack in the Box and Yum saw increases. That's partly due to the big acquisitions they made. Again, Yum with Firehouse and Jack in the Box with Del Taco. So yeah, putting those together, you get EBITDA margin. Basically a combination. Last year, this was up across the board, but it's a much more mixed story this year. Whether or not the reduction in gross margin could be made up for with improvement in SG&A margin, really. And there's not really a consistency by category either. It's really on an operator by operator basis. We see some casual dining gains from Denny's, and then declines from Brinker and Texas Roadhouse. Texas Roadhouse as a steakhouse, they've been hit really hard by beef inflation. It's nearly 20%. For fast casual, we're seeing gains from Chipotle and then declines from Noodles and Company. So it's not really any specific trend there. There are a few operators that have pretty thin margins that we are worried about. I discussed Potbelly just before, but that 2.2% on a TTM basis is very thin. It has improved to a 5.2%, a little bit, as of the 2Q itself. So I expect that to come up, as we cycle some of those were underperforming periods. And then another one, Carol's, that's fallen to 2.9%. It's definitely a concern. That's part of the reason why we downgraded them to D1 recently. Carol's issues, they stem from the same issues, commodity and labor inflation. In 2Q, Carol's wage rates were up about 10%, and then commodity inflation, they were reporting it was 19%. On top of that, they're a franchisee, so they have to pay the royalties to Burger King restaurant brands. So they're definitely struggling as of late. Now, our second spotlight here is Wendy's. Wendy's, we have them rated as a C2. They've been on the upswing for the last couple of years, the number 2 burger chain behind McDonald's in America. And as QSR, they performed fairly well during the pandemic. 2Q comps were up 2.3%, and that was on top of a 16% increase in the prior year period. Now, what's been concerning about them recently has been the margins. Restaurant margins slipped about 580 basis points in 2Q, and I'm starting to sound like a broken record here, but it's really, commodity and labor inflation eating into that. But for Wendy's, they've also incurred some higher costs from their own initiatives. Specifically, its entry into the UK. Wendy's previously tried to enter the UK about 20 years ago. That didn't work out. Now, in the last year, they've opened just over 20 stores there. Their hope is that if they get a good store base in the UK, they can expand to the rest of Europe. Kind of remains to be seen. And recent news with this Reef partnership also puts that into question. Now, Reef is a ghost kitchen operator, but they had signed a deal with Wendy's last year that they were going to open somewhere around 700 stores by 2025. And then earlier this year, they announced that actually it's not going to be 700, it's only going to be 100 to 150. So that's a very big scale back. Basically, the reasoning behind this was Reef came out and said, these AUVs, the average unit volumes, they're not doing so great. The ones they have in the US, those AUVs are only $500,000. You compare that to a normal Wendy's, which is 1.7 to 1.8. That's clearly not making muster there. And Reef basically said they want to do multiple concepts within the same store. That's what a ghost kitchen is. Delivery only. They serve multiple concepts out of the same store. It saves on a lot of costs that way. And Wendy's is not comfortable with that. They didn't want to do that, so they had to change their partnership that way. Basically, it's a little bit of a cautionary tale when it comes to these ghost kitchen partnerships. Not only does it have to make sense for the concept and also the operator, it has to be in the right location. There's a lot more that goes into it than just buzzwords. For Wendy's, they expect about 75 Reef locations to be open by the end of this year, and they're gonna have to relocate about 35 to 40 of them. You know, it might be better if you are QSR to just work on developing your delivery and drive-through, and if you are a casual dining company, it might be better just to do that in-house. If you want to have like a delivery only location. Otherwise, Wendy's they issued about $500 million in senior notes earlier this year. Most of those proceeds are still on the books as cash, and they haven't exactly said what they want to do with it. They might refinance existing debt. They might do a shareholder dividend. So that's still up in the air for them. But otherwise, they have plenty of cash, plenty of availability. Okay. So here is CapEx margin. With store expansion picking up, CapEx spending has also picked up. Companies really want to build up their store pipelines. Maybe some of them were delaying store remodels, but they put them back on track this year. It's really important to make sure these stores are up to date and appealing for the customers. And things like upgrading the drive-throughs and maybe changing a layout to better handle delivery, all that stuff is feeding into the CapEx here. As I mentioned earlier, we are seeing some, raw material delays. That's really just pushing the spending out, maybe a period or two. A few companies I did want to point out here, Cracker Barrel, their 10% increase last year, 10% CapEx margin, last year. That was a one-time thing, one-time transaction where they had a sale leaseback. The 2.7 is closer to their historical spending level. Steak and Shake's big jump, again, that's because they are shifting a lot of their restaurants from full service to self-service. So that's a lot of remodeling required. I think about $100,000 per restaurant. And then Wingstop's big jump was a lot of it was related to tech infrastructure that they're spending on. That was a big differentiator for them before, in the early days of the pandemic. So they still want to make sure they're top of the line there. But everyone's really trying to improve their digital platform and the capabilities there. I would say looking ahead, CapEx is probably going to rise a bit for some companies, but a bunch of others, especially the big franchisors, that's probably not going to change. That's probably right about where they expect it to be. So here we have the TTM free cash flow over sales. Free cash flow is a measure of financial flexibility. Ideally, they're paying down debt with the cash flow. A lot of the time it goes to dividends, share repurchases. For the casual dining restaurants, their free cash flows have come down a bit. And we've seen a lot of them, now that they're more comfortable with their liquidity positions, they're restarting share repurchases and dividends. Having negative free cash flow like some of the ones you see in the middle here is generally not great, but not necessarily a bad thing. For example, Shake Shack. They have negative free cash flow again, and they had it last year too. That's because they're spending a lot on their expansion. Back in March 2021, they issued a $250 million note, and they're spending that cash to expand. We can't all be like Chipotle, which can self-fund its expansion. So depending on where the cash is going, free cash flow in the negative territory is not always necessarily a bad thing. Now, on the other hand, companies like Potbelly and Red Robin, they still have slightly negative free cash flow. That was more a function of their slower operating recovery. So they were actually, the operations weren't making up for it. And of course, if you look at some of the major franchisors like McDonald's and restaurant brands, they all generate consistently strong cash flows. They're raking in the royalties from the franchisees. So here we have our spotlight on Denny's, a carryover from last year. Comps are all positive now, up 2.5% in 2Q, 11.5% year to date. The big issue we had with them last year was that they couldn't get more of their stores to the normal 24/7 operating hours. And that problem has kind of continued. They're only about 53% of their stores are operating for the normal 24/7 hours. That's up from 40% last year, but clearly not at the 100% you want it to be. staffing is the issue. Limited hours stores are about like 80% staffed compared to a normal store. It hasn't hurt as much this year because of the broader recovery in the restaurant industry, but is still definitely a priority for the company to get more stores to full 24/7 because those stores are outperforming, comps wise by a lot. Now the chart at the bottom right here, it's a little busy. I apologize for that, but it's basically showing sales by quarter and then a breakdown of where those sales are coming from. That's the bar chart. You can see the overall sales trend is now higher than pre-COVID levels. Comps versus 2019 were up 2% in 2Q. But you can also see that the off-premise mix is trending down from the COVID highs. The yellow and the orange bar there. It's still well above pre-COVID levels, but it is on the downswing there. The virtual brands, they're adding like about 900,000 to 1 million. They're adding a consistent amount to that. As a reminder, Denny's virtual brands are these burger and sandwich concepts. They're designed more to sell in the late dinner hours, take advantage of times that are traditionally slower for the Denny's main concept. But just like we described with the ghost kitchens, there's probably like a harder limit to what these virtual brands can actually contribute. They're not going to necessarily revolutionize the concept, but they can add some incremental sales that Denny's otherwise would be leaving on the table. So overall, positive trend for Denny's, hopefully getting better over time. But the company decided to shake things up a little bit this summer when they acquired Kiki's Breakfast Cafe back in July. Now, Kiki's is a mostly franchised breakfast concept. It's all located in Florida, about 50 stores. Their AUVs are a bit higher than Denny's at a 1.9 to 1.6 million, and they sell at a higher price point for their menu, and their margins are a little bit better there. Now, from a balance sheet standpoint, Denny's used revolver borrowings to fund the acquisition. On a pro forma basis, we expect this to raise their leverage to about 3.1 times. Management also raised their target range for their leverage to 2.5 to 3.5 times. So conveniently, they're right at the midpoint of that now. Even still, this increased leverage may warrant a downgrade for them in the near future. It depends on how well their operating performance continues, I would say. Here's just an example of the stock prices over the past year. A lot of red there, kind of reflecting the entire stock market. The big difference, I guess, the only positive there was round one that had an increase there. That's Japan-based. And then you can see the Carol's and Red Robin noodles, the ones that struggle a little bit more the past year are the ones at the bottom. So here are some of the warning signs and debt metrics we're going to go into now. First one is percentage available under credit facility. So now to start off here, you got to note that some companies have different, strategies, policies when it comes to their revolvers. Some of them, never touch them, like Chipotle and McDonald's. They don't have a need. It's always 100% for them. Others treat it almost like cash. They hold very little cash itself, and then they use the revolver for working capital needs regularly. This past year, we've seen a bunch of companies pay down their revolvers, getting it back to full or near full availability. And in a lot of cases, we've seen companies refinance their revolvers and extend the maturities. Cracker Barrel is one of those that did a refinancing recently. Texas Roadhouse, they increased their revolver capacity by about $100 million. BJ's restaurants, they had a share issuance and used some of the proceeds to pay down their revolver borrowings. At the same time, some of these companies that had negative free cash flow, they had to tap their revolver to plug the cash burn. Potbelly is an example of that. They've had to add a little bit. I think with the forgiveness of their PPP loan, they may pay down the revolver. And then I just mentioned Denny's. They used revolver borrowings to fund the acquisition of Kiki's. Now, generally, our warning sign is about 25% availability, but the restaurant companies in our coverage right now, they're all pretty far above that. Now, moving on to debt to TTM EBITDA. Similar to percentage available, debt to EBITDAs have come down as companies have repaid the borrowings and their EBITDA hasn't recovered. Our warning sign for this metric is typically 3.5 times. But you can see a lot of these big franchisers, big QSR franchisers, are higher than that. And even Dine Brands too, they're a big franchisor of casual dining. They're higher than that. That's a bit by design. Their franchise businesses, they generate a lot of free cash flow, and that cash tends to go towards dividends and share repurchases as opposed to paying down debt. These companies don't really have an issue refinancing debt as needed, so they're more comfortable with the higher debt balance. There are a few companies that I wanted to note for their increases, though. Carroll's is more a function of their weakening EBITDA than any increase in debt. And then Jack in the Box, they had an increase due to their acquisition of Del Taco. Similarly, Dave & Buster's, after 2Q, they acquired Main Event, and that's going to increase their leverage. Also, Wendy's too. We mentioned that they had that debt issuance earlier this year. They haven't yet decided what to do with that. If they use it to refinance debt, obviously it would come down. TTM interest coverage, very similar story to the last two slides. Companies paying down the short-term borrowings to probably reduce interest expense here. But overall, most of these companies are above our warning threshold of 3 times interest coverage, and a few of them are much improved. That brings us to our credit rating. You can see a lot of green there, a lot of upgrades in recent periods. We've continued to upgrade, the restaurant companies as their operating performance has improved, as some of them have improved their leverage. This amount of upgrades is not going to continue, especially with the market becoming more promotional and inflation kind of hurting the traffic. As I mentioned, Potbelly might be an upgrade if they can show more sustained improvement. Denny's or Dave & Buster's might warrant a downgrade due to the leverage they've taken on. But in general, this is close to where we were, I think, pre-pandemic. I think some of these probably will have changes in the coming quarters, but a lot of them are kind of more stable, I would say. Okay, that is the end of my prepared remarks. If anyone has any questions, feel free to enter them now, or you can always reach out to me. There's my contact information here. And again, speaking broadly on a lot of these things, if you want to talk about a specific company or anything like that, also feel free to reach out to me. We'll just give it a few minutes, see if anybody has any questions. Okay, well, yeah. Thanks again for everybody for attending. Again, my contact information is here. Please feel free, reach out anytime. Thank you. Have a great day.